Me. The floor is yours. Welcome.
Hi, good morning. Wow, that is quite the introduction, Michael. Thank you so much. I really appreciate the kind words. I'm thrilled to be here this morning as well. So I want to thank everybody for being here with me. I know you've got places that you could be, and for you to choose to be here with me, I'm absolutely thrilled. So I'm going to throw up onto the screen my slide deck for this morning, and you should see it all coming onto your screen now. If anybody has any issues with viewing it, then let me know. I'm also monitoring the chat log. At least I should turn on the chat log at least. Let me get that going here. Oh, okay. Just can't seem to find the chat log. Oh, there it is. Got it. Yeah. So if you have any questions, put it up into the chat log. I'd be happy to monitor that, and I'll answer questions as we go. So for today, I want to talk about some non-resident tax issues, principal residence tax issues as well. You've probably, especially now at the end of the calendar year almost, you've obviously had some clients that might have sold their principal residence. So this will be really good, timely information for you to pass on to them. And of course, you might have some clients that are affected by the underused housing tax. So I'll talk about those issues today as well. Now, before we get in too far, I want to make sure that I highlight that anything I talk about today is intended to be generic in nature. I don't intend to provide specific accounting or tax advice today. So before you act on anything that we talk about today, make sure that you either talk to me or refer back to your own accountant. The point being is that you don't just go and do something based on whatever we talk about today. You guys already know a little bit about me. Michael's done a fantastic introduction, so thank you again, Michael, for that. And then, of course, our agenda for today will cover those three topics of the non-resident tax issues, the principal residence exemptions, and, of course, the underused housing tax. And I'll make sure towards the end of our session today, I'll save about 10 or so minutes to answer any questions. But also, as I said earlier, if you have any questions, don't hesitate to put into the chat module, and I'd be happy to answer those questions for you. Okay, so let's get started with non-resident tax issues. And, I don't know how many of you deal with non-residents in your line of business, but I suppose Century 21 in-town realty being in the downtown core, you probably have, several non-resident clients. So I figured this might be a timely topic to talk about. For your non-resident tax payers, typically you've got two types of tax issues. The main one being the rental income, and the other one happens when somebody actually goes and sells their real estate property as a non-resident of Canada. And I want to highlight too that when I talk about non-resident of Canada for the purposes of income tax, I'm not talking about those who are Canadian citizens or permanent residents, because they might be captured as well under the non-resident tax rules. So non-residents for the purposes of income taxes primarily refers to any taxpayers who are not reporting tax returns here in Canada and are not paying income taxes here in Canada as their primary place of residence. So you could be a Canadian citizen or a permanent resident living abroad, but still earning rental income here or selling residential property here. You would be captured under the non-resident tax rules. So with respect to rental income, every person who has rental income here in Canada should either have a social insurance number, or if they've never had a social insurance number or are not eligible for a social insurance number, they need to apply for an individual tax number for non-residents. So that's called an ITN. That number is really important because without that ITN number or a social insurance number, your taxpayer client has no way of communicating with the CRA. Now, when you've got rental income, the person who is paying the rental income to the taxpayer is typically the tenant, or ideally, there is a property management company in between. I mean, that's really, really important to have a property management company in between, because monthly withholding taxes are required to be remitted to the CRA, and failing to remit those withholding taxes will result in late filing penalties and interest as well. And the withholding taxes are applied on the gross rental income at the rate of 25% per month. So if your rental income is $2,000 a month, you're sending in $500 per month every single month for as long as the property is tenanted. Now, when you're sending in money to the CRA, you do have the option of filing a Section 216 return. So make sure that your clients know that there's a Section 216 return that is optional for them. And when they file that return, there's a very, very good likelihood that they will be able to obtain a tax refund, because typically when you are remitting that 25% per month, that rate of remittance is significantly higher than what the actual tax rate would be for the rental income for that non-resident taxpayer. The Section 216 return also has a 2-year filing deadline. So if your client fails to file the optional return and the deadline passes, they're not going to be able to late file a Section 216 return. And there's a significant amount of money that would have been sent to the CRA for which they would not be able to claw back. So again, a Section 216 return is optional. There's a 2-year filing deadline. And if they choose not to file it, I guarantee you they're probably sending too much money to the CRA. Okay. Now, for some people, sending in 25% per month is a lot of money for, you know, the rental income. And especially nowadays with interest rates being as high as they are, that could result in a negative cash flow for the property owner. So what the property owner has as an option is to file an NR6 form every single year. And the NR6 form allows them to send in remittances on a net rental income basis. So if they were earning $2,000 a month gross rental income, minus strata fees, minus property taxes, minus insurance and other expenses related to the property, they might be turning $1,000 of net rental income per month. Well, with an NR6 form filed, they'd be able to send in 25% of that net rental income of $1,000 per month instead of the gross rental income of $2,000 per month. So that makes a significant difference for the actual cash flow. So if your client files an NR6 form, then the Section 216 return becomes mandatory, no longer optional. And the deadline to file that Section 216 return becomes 6 months after year end instead of 2 years after year end. So there are significant benefits with filing that NR6 form, but in exchange for that NR6 form, the CRA requires that you file your Section 216 return annually and requires that you file it by June 30th of the following calendar year. So here's a little graphic illustration for easy reference. And I should also point out that, Michael, I'll send you the slide deck after our meeting this morning, and you can then distribute the slide deck to your team as well for their reference. So here with this graphic illustration, you've got gross rental income of, you know, whatever dollar amount that is. You then need to send in 25% withholding taxes to the CRA. This often results in an overpayment of taxes. So then the taxpayer has the option to file a Section 216 return to recover the overpayment. Okay. Now, in another example where you have somebody selling real estate, this is a slightly different process, but you'll notice that there are some similarities with regards to the rental income. So when you have a non-resident seller, you will know if the non-resident seller is a non-resident because they're going to tell you, right? And as part of the, you know, knowing your client, knowledge of your own business, you know, you're also supposed to inquire about, you know, what your client's status is here in Canada. So as soon as you know that you are dealing with a non-resident seller, I strongly recommend that you get them in front of an accountant as early as possible. This way you can ensure that your client, your seller, has the right advice and are given information as early as possible. Okay. So when it comes time to accepting an offer, they're going to need to indicate that they are a non-resident seller to the potential buyers. And once that indication happens, then when it comes time to closing, 25% of the sale price will be withheld in your seller's lawyer's trust account. So 25% is a pretty substantial amount of money. If we're talking about, you know, a $2 million sale price, we're talking about $500,000 being withheld in a lawyer's trust account. And if your seller needs access to all of the net sales proceeds, you will need to ensure that they know that they're not going to have access to all of those monies, right? Specifically, they're not going to have access to 25% of the sale price. So the remaining 75% of the sale price is what they're going to have access to. And that 75% of the sale price needs to discharge the mortgage, needs to discharge any other adjustments and liabilities on the vendor's side. So if your client has a highly leveraged property with a high mortgage amount, they might need to actually fund the lawyer's trust account with some of their own money to ensure that the discharge, so that to ensure the mortgage can be discharged. So simply for that reason alone, you really should get your client in front of an accountant as early as possible, so that we can have those conversations with your client, so that they know they're not going to have access to all of the net sales proceeds. Okay. Now, once the closing date comes, your client has 10 days, 10 calendar days to file a clearance certificate application. A lot of the work that goes into that clearance certificate application can be done before the closing date. So for myself, for example, we often collect information about the property. We collect information about the original purchase of the property. So the statement of adjustments from the original purchase and all these other documents from the original purchase. We can get all of that beforehand and start working on the file, so that when it comes time to closing, all we then need are documents related to the actual closing of the sale. So statement of adjustments, trust account reconciliation, other documents that we need from you as the realtors as well. The MLS listing, for example, contract of purchase, we can get all of that relatively quickly. And then that ensures that we're able to file within 10 days of the closing date. Now, if you miss that deadline, the penalty is $25 per day, to a maximum of $2,500 per seller for filing a late clearance certificate application. So if you have one seller, it's $2,500. If you've got two sellers and you're late to the maximum, it's a $5,000 penalty. So we're not talking about small amounts of money here. We're talking about pretty substantial penalties for filing late. And it's so easy to just file on time. And the only time we don't file on time, truthfully, is because either the client doesn't get us all the information that we need for the purposes of applying, and usually those are all client related issues for why the clearance certificate is filed late. Okay. Next in the process is about 1 month after the closing date, we're then able to apply for a comfort letter. That comfort letter is really just an acknowledgement from the Canada Revenue Agency that the clearance certificate application was received. And that ensures that everybody in the transaction, including the buyers as well, knows that this process has been started, and it's just a matter of time for the CRA to issue their clearance certificate. Eventually along the process, once the CRA reviews the application, they're going to provide us with instructions on how much money to remit to the CRA, where we are going to remit to the CRA, and they'll also provide us with a remittance voucher to ensure that the funds, once sent to the CRA, are routed to the correct taxpayer account number. Okay, we have had instances in the past where monies get sent to the CRA, and for one reason or another, the CRA misplaces those funds. And that would be, a pretty significant delay, because then we're going to have to go and try to get the CRA to trace those funds. So that's not always very fun to do that. So, we always want to make sure that when sending money to the CRA, there is a remittance voucher attached, which comes from the CRA themselves. Now, this whole process, you'll note at the very, very end of that graphic illustration, the whole process takes anywhere between 5 to 7 months, sometimes longer. All right. So right now the CRA is tracking at about that 5-month period of time. So your clients need to know that during this entire process, 5 to 7 months, they are not going to have access to 25% of their sale price. Once that clearance certificate is received, we will send the clearance certificate to the lawyers. And then at that time, that's when the rest of the trust funds will be dispersed to your seller. Okay. So you can see there's quite a bit of time that passes between the actual closing date and then, of course, the time that they actually get access to all of their money. So, you got to really make sure that your clients are aware of some of those tax issues as a non-resident landlord, as a non-resident seller. There's definitely a lot of tax issues there. And I don't expect you to have to tell your clients about it. All I'm suggesting to you is that as soon as you know that you're working with a non-resident, get them in front of the right people so that we could help you get them the information that they need, so that they can, meet their tax obligations. Okay. All right, so I'm going to move on to the BC speculation and vacancy tax. But before I do that, I'm just going to take a quick glance at the chat log. If there's any questions, put it up in there. Let me know. I'd be happy to answer them for you. I don't see any questions there so far, so I'm going to move on. But again, don't hesitate to put your question up in there, and I'd be happy to address that question for you. Okay, so with regards to the BC speculation tax, we all know it's been around for quite some time. So this isn't necessarily new, but I always find it a good idea to kind of rehash some of these things so that, it stays front of mind for all of your property owners, and especially as real estate agents, you guys are going to be the front line of defense for all of your clients, right? We know that the BC speculation tax is intended to target properties that are not used for an exempt purpose. So, the BC government wants to have the property used for long-term residential tenancies. So the tax targets both foreign owners and BC domestic owners who are not using the property for an exempt purpose. And the idea, of course, is that the tax revenues generated from the BC speculation tax are then returned to used for affordable rental housing and other affordable housing initiatives. But whether those funds are actually used for that purpose or not, I guess we won't really know for sure. But that's really the purpose of the whole tax. Now, for several years now, we already know that the BC speculation tax applies to the Capital Regional District, to Metro Vancouver, to the Fraser Valley, like Abbotsford, Chilliwack, and Mission, and then going into the interior, like Kelowna and West Kelowna. We also know that it applies on Vancouver Island insofar as Nanaimo, Lanцeville, as well as the Victoria region. Now, new for 2023 is an expansion of the specified regions for the BC speculation tax. So if you have property owners in Duncan, North Cowichan, Lake Cowichan, Ladysmith, and then now a big one is Squamish is included in the BC speculation tax as well. Lions Bay is also included in the BC speculation tax. Those areas are all new for 2023. So if you have clients that are property owners in these new regions, they will receive a letter from the BC Ministry of Finance asking them to make a declaration. So with these new taxable regions, it's always really important for everybody to know, if they're going to be captured in a taxable region, of course, because they're going to want to make sure that they're using their property for an exempt use. Now, in terms of the tax rates, it's 0.5% for those people who are Canadian citizens or permanent residents, not including satellite families. And I'll talk about what a satellite family is in a little bit. And then if you are a non-Canadian or you are a member of a satellite family, your tax rate is 2%. Okay. BC residents, if you have a secondary property that you're not using for an exempt purpose, then you will qualify for a non-refundable tax credit of approximately $2,000. So that's the equivalent of a second property that is worth up to $400,000 at a 0.5% tax rate. But if you have a property that is valued at more than $400,000 and you're not using it for an exempt purpose, then as a BC resident, you'll find that you'll also be subject to the BC speculation tax, despite receiving a credit of $2,000. Now, the credit itself is shared proportionally among all owners. So if you got a husband and wife, spouses, partners, whatever the case may be, that $2,000 non-refundable tax credit is applied on a per property basis. So you can't multiply that non-refundable tax credit simply by having more property owners on the land title registration. Okay. You'll also notice here that I did indicate that non-BC residents would be eligible for that non-refundable tax credit as well, to the extent that the non-BC resident would have income here in BC. So maybe they have some of their income reported in BC, some of their income reported outside of BC. The proportion of that will determine whether or not you have additional tax credit with regards to the BC speculation tax. Now, one of the biggest things that people are confused about, right? A lot of my clients, they still have some confusion around what is a satellite family. And the best way for me to describe what a satellite family is, that is a family whereby the spouses, the combined income of the spouse is taxed outside of Canada, right? So if you are, let's say, a spousal couple, one of you lives somewhere else in the world, the other lives here in BC, but more than 50% of the family income is taxed in some other jurisdiction, well, that makes the spouse who's living here in BC a member of a satellite family. And if you are a member of a satellite family, then of course you would be taxed based on the fact that you are a satellite family, okay? So that's really important to understand, because a lot of people don't catch on to the fact that they are a member of a satellite family, and that often gets them caught later on under secondary review or an audit by the BC Ministry of Finance, okay? So I want to highlight here that a Canadian citizen or a permanent resident who lives here, works here, pays taxes here, could still be a member of a satellite family if their spouse lives and works somewhere else and most of their family income is taxed in some other jurisdiction, okay? Do we have any questions about the satellite family? No, doesn't look like it. Okay, so with that being said, you got to make sure that you declare every single year, because if you don't declare, then of course the default is the tax is applicable to you. So failing to declare will trigger a BC speculation tax levied to the individual. You got to file every single year. You will receive a letter in the mail every single year, usually around the beginning of February, you'll receive a letter. And if you are a property owner on December 31st, then you will receive a letter in February for that specific property. That letter will have a couple of numbers on there that are really important for you to file. There's a declaration code and there's a letter ID. So both of those numbers you will need for you to make your online declaration. And of course, you'll need your social insurance number, some other personal information for you to file, okay? Now, I want to go over some common exemptions, because truthfully, there are actually a lot of exemptions available out there. The primary one being a principal residence exemption. So if you occupy that property more so than anywhere else in the world, that is a principal residence for the purposes of the BC speculation tax. So occupying this property more so than anywhere else in the world does not require full-time occupancy. It just means that you need to live there more than anywhere else. So if you spend 4 months here in BC, 3 months somewhere else, 2 months somewhere else as well, but at the end of the day, you're living here, you're filing taxes here, and you occupy that place more so than anywhere else in the world, then that is a principal residence exemption available for you, okay? I did note here as well that spouses are required to designate the same property as the principal residence for the purposes of the BC speculation tax. But under certain circumstances, spouses can designate different principal residence if they are living apart for the purposes of work, for the purposes of some medical reason, or if there's a marital breakdown and they're undergoing a separation, the spouses can designate different properties as their place of principal residence. But otherwise, normally you have to designate the same property among spouses as your principal residence. Another common exemption would be the occupied by tenant. Now, it's really important to highlight that when it comes to a tenant, you could have a non-arm's length tenant, so somebody who is related to you, or an arm's length tenant. And if you have an arm's length tenant, then really all you need is a tenancy agreement. Your arm's length tenant, they just need to occupy that property for at least 6 months out of the year. You don't have to have the same tenant for 6 months. You could have one tenant for 2 months, another tenant for 3 months, and another tenant for another 3 months. Those tenancies combined will add up to the 6 months that you need for the purposes of the occupied by tenant exemption. Okay, I want to point out that each tenant period must be for a period of at least 1 month. So if you have a tenant living in there for 2 weeks, that doesn't count. They got to be in there for at least a month. Okay, and the tenant themselves, they must be occupying the property as their principal residence too. So the tenant cannot be using the property as a vacation property. They must be occupying that as their primary place of residence. Okay. I want to tie this into the new BC province regulations with regards to short-term rentals. The BC government considers a short-term rental for the to be a period of less than 90 days. Okay. Now that is the purpose of legislation for the short-term rentals prohibition. But for the purpose of the BC speculation tax, that hasn't changed. This BC government considers a duration of at least 1 month in length to qualify as a tenanted period for the purposes of the BC speculation tax. So you can see where it's really wonky here, where under the same government, the BC government, for the purposes of one legislation, they consider anything less than 90 days to be short term. And yet for the BC speculation tax, they're okay with 30 days or more being a long-term residential tenancy. You know, there's some inconsistency for you. So if your client is a non-resident and they're renting out their property, they want to make sure they rent it out for at least blocks of 1 month or more, totaling to a 6 months minimum for the year to be able to get the occupied by tenant exemption. The last bullet point that I've got here is that if there is a multi-family unit, so if you've got a typical example would be the main home and then you've got the basement suite, right? So the basement suite is not a separate PID. It's not a separate property. It is a self-contained dwelling unit within the entire property itself. So if you've got a basement suite or some other property like a laneway or a coach home, for example, and the entire property itself, you've got that self-contained dwelling unit rented out for at least 6 months out of the year. Well, that one self-contained unit, if you get an exemption for occupied by tenant for that, then the entire building itself will be exempt under the occupied by tenant exemption. So a really good example of that would be, for example, you know, back in 2016 when the BC speculation tax was rolled out, you might recall that there were multi-million-dollar homes being rented out for below market value rents, right? Especially if it's just a basement suite. People were allowing below market rents just so that they could have a portion of the property tenanted so that they can get their exemption by occupied by tenant, right? So there's a really good example of how that occupied by tenant could work to your property owner's advantage. Now here I want to talk about non-arm's length tenants because that one becomes a very contentious issue. Oftentimes it's somebody who otherwise would be a non-resident and would be captured under the BC speculation tax. They're trying to get an exemption by leasing the property to somebody who's related to them. So a non-arm's length rental. So I want to make sure that, you know, when we talk about non-arm's length rental, we're not talking about just family relationships. We're also talking about any other type of relationship where the landlord and the tenant, either one of them is dealing at an advantage over the other, okay? So you might have an employer-employee relationship where there's a tenancy there. I mean, that could be a non-arm's length rental. You might have, well, I think that's probably the best example I've got. When it comes to a non-arm's length rental, there are additional criteria that is required when the owner is not a Canadian. So when the owner is a Canadian, you're free willing to do whatever you need to do. So you don't necessarily need to have a tenancy agreement, you know, because you're already a BC resident. You can have that occupied by your children. It doesn't matter, okay? But when the owner is a non-Canadian and they have an arm's length rental, then there are additional qualifying criteria imposed upon the tenant so that the owner could then get an exemption from the BC speculation tax. So several of those criteria are that the tenant themselves must be a Canadian citizen or permanent resident. The tenant themselves must also be a resident of BC for the purposes of income taxes on December 31st. The tenant themselves must also not be a member of a satellite family. And then here's the really big issue is that the tenant must have 3 times the market value rent in the form of income taxable here in BC. So if you've got, somebody who is a non-arm's length tenant, they are related to you, maybe they are your nephew, your niece, whoever, and they're renting that property from you, and you otherwise would be captured under the BC speculation tax. Your tenant now needs to have at least 3 times the fair market value rent in income. So for example, if the property normally rents for $2,000 a month, then your tenant must have $6,000 a month of income for you to be able to get that exemption. Okay, now that's a significantly high threshold. And usually where I'm seeing these types of rental arrangements, it's often the case that the tenant does not have 3 times the fair market value rent in the form of income here in BC. So that would cause the property to still be subject to the BC speculation tax. Okay. Other exemptions would be if you are actively developing the property. So land under development would qualify an exemption. Some examples of this would be your owner would need to be undertaking some sort of building activity. Now, building activity is actually a fairly broad term, and the BC Ministry of Finance has really kind of provided significant leeway in what is included in building activity. So a property owner could be applying for financing, applying for permits. They are interviewing contractors, general contractors, entering into contracts for design, for building, for engineering. They could be demolishing the property. They could be clearing or excavating the land of any sort of brush and debris that they need to prep the land. I mean, there's a lot of activities that are considered to be building activities. So if a property owner is not utilizing the land for some exempt purpose, but they are preparing to develop the land, just know that there are exemptions available for that as well. Another common exemption would be if there was a recent death of an owner. So you might have somebody who passed away, that there's an automatic exemption for that. If there are multiple owners on title and one of those owners pass away, everybody who is listed as an owner is also exempt. And the exemption is applicable for the same calendar year of death, but also applicable for the subsequent calendar year of death as well. So if somebody passes away in 2023, there's an exemption for the 2023 filing, but there's also an exemption for the 2024 filing as well. Okay, so there's lots of available opportunity there when it comes to a death of an owner for you to get an exemption from the BC speculation tax. And everybody, there's lots of other exemptions as well too, but for the brevity of today's conversation, I didn't want to go into every single one. So if you need to, you can always take a look at the BC speculation tax website, where the BC government will list out a whole bunch of other exemptions. Okay. All right, so do we have any other questions so far? I don't see any. I'm monitoring the chat group, but no questions on there. Again, don't hesitate, people, to put your questions in the chat module. I'd be happy to answer your questions as we go along. Okay, so I'd like to talk about principal residence exemptions, because I'm sure that during the course of this last calendar year, many of you have helped people sell their principal residence. So it's pretty clear that there is an exemption available for the sale of a principal residence. But, if for several years now, taxpayers are required to report the sale of their principal residence. So all sales of real estate property must be reported on a tax return. And whether they are eligible for an exemption is a separate matter. So your taxpayer would then need to go and apply for an exemption. And of course, if they don't qualify for an exemption, then the capital gain would be taxable. I do want to point out that failing to report the sale, and therefore would usually result in failing to claim the exemption, that could leave your property owner or your seller open to a reassessment for the taxes on the capital gain. So it's really important that if you have helped somebody during the course of the year sell a property that is a principal residence for them, they need to know that they need to report that sale. Okay. So what is a principal residence? I want to make sure that I make a distinction between principal residence for the purposes of income tax versus principal residence for the purposes of the BC speculation tax, because different legislation will define principal residence or primary residence differently. Okay, so for the purposes of income taxes, a principal residence is a property that is owned directly by the taxpayer, not a property that is owned through a trust, not a property that is owned through a corporation. So the property needs to be owned by the taxpayer. The taxpayer must ordinarily reside in the property. Now, ordinarily reside does not require full-time occupancy. It includes a vacation property as long as they're using the vacation property on a regular basis, okay? And ordinarily reside also does not mean that the taxpayer themselves has to live in the property, because if the taxpayer's spouse or the children of the taxpayer also resides in the property, then the property would qualify as ordinarily resided by the taxpayer. So a property that is owned by the taxpayer but occupied by the taxpayer's children would qualify as a principal residence. Now, in the year of the sale of the property on the tax return, this is where the taxpayer would designate the property as their principal residence when they sell the property. So the designation of the principal residence happens on the personal tax return for the year in which the property is sold, okay? I do want to point out that a family unit must designate the same property as their principal residence. You cannot have spouses designating different properties as their principal residence. And you can only designate one property as a principal residence for one particular calendar year. So for example, if a particular property was owned for 5 years, then you would have to designate that property for those 5 years. But if you had some other property at the same time that you had owned, and maybe you had sold previously, if you already claimed the principal residence exemption with that other property and there was an overlapping ownership period, then it may be a situation where your seller isn't eligible for a full principal residence exemption because they already used it for some other years in the past. So it's always really important that there's, you know, a diagram or some sort of an assessment for where a taxpayer might have already used the principal residence exemption. And this really comes up often when there are more than one property owned simultaneously, okay? Now, I want to point out too that changes in a principal residence use would also trigger potential capital gains and therefore trigger a reporting requirement. So where somebody has owned a property and instead of selling it, they decide to convert it into a rental property, that is a change in use, and that triggers a reporting requirement with the Canada Revenue Agency. So even when a property isn't actually sold, but the change in use from a principal residence to a rental property, that triggers a deemed disposition and triggers a reporting requirement. So think about all the clients that you've worked with during the year where you didn't sell their house, but they just moved out and they started renting it out. There's a reporting requirement there, okay? And on the flip side, if somebody was renting the property and then they decided to evict the tenants and move back in themselves, that is also a change in use. And there's also a potential capital gain issue there as well. So, you know, to really highlight this, even a change in use will trigger a capital gain issue. So you want to make sure that your clients know that changing a property's use could get them into a tax reporting obligation, okay? Now, a partial change in use could happen as well too. So if somebody were to build a laneway, that's a partial change in use. If somebody were to start renting out their basement, that's a change in use. If somebody starts using their home as a place of like a home office, that's potentially a change in use. Now, the CRA does have some exemptions for partial changes in use. So if you started using your home office, for example, or started renting out the basement suite, then the CRA allows for an exemption whereby they will say, okay, there's no change in use as long as the income producing portion of the property is really a secondary or ancillary use to the property as a whole, being your principal residence, okay? Also, they will allow for a no change in use if there was no structural changes made to the property. So you can't go and, you know, make a separate entrance if a separate entrance wasn't there before. That's a structural change. You can't go and put up a wall or take down a wall that was previously there. If you start doing those things, then what you're actually doing is making structural changes to the property that will make the property more conducive to earning rental income. That will get you into a partial change in use. And of course, if you are earning rental income from the property now, you must report the rental income. And of course, you cannot claim capital costs allowance as the deduction against your rental income. So those are the three things that the CRA will allow for and ensure that you are not triggering a partial change in use. Okay. Any questions so far, ladies and gentlemen? I think you guys are being really nice to me here. Nobody's asking any questions at all. Okay, so I see we've got about 10 minutes or so left on the clock, so I want to use that time to talk about the underused housing tax. This is a big one because, of course, the federal government, seeing the provincial government and seeing the city of Vancouver getting in on the action for taxing properties that are not being used for an exempt use, the federal government decided to get in on it as well. So they came out with this thing called this underused housing tax. The underused housing tax was announced back in 2000 and I think it was late 2022 when they announced it. The initial filing deadline was April 30th, 2023, which then got extended to October 31st, 2023 for your December 31st, 2022 reporting date. October 31st has come and gone, obviously, and then the government literally at 1:30 p.m. Eastern Standard Time on the filing deadline of October 31st, they extended the filing deadline to now April 30th, 2024. So on April 30th, 2024, a property owner who is an affected owner must now file 2 UHT returns, one for the December 31st, 2022 reporting date, and the second for the December 31st, 2023 reporting date. Both those UHT returns are due on April 30th, 2024. So if you have clients that are affected by the underused housing tax, make sure that they know that they have a filing obligation. So the UHT is targeted at foreign owners who are underutilizing their property, okay? Foreign owners, that means non-Canadian citizens, non-permanent residents. That's the best way to describe a foreign owner, okay? Similar to the BC speculation tax, there's obviously exemptions available to you. But one of the challenging things with the underutilized housing tax is you don't necessarily know if you have to file. Because unlike the BC speculation tax where they send you a letter so you know you have to file, a person needs to identify whether they are part of the excluded owners or the affected owners. And there's a lot of confusion around who is an excluded owner, who is an affected owner. Some people who would normally otherwise be excluded owners are actually affected owners. So we're going to talk about that today. Now, before we get into that, I want to point out that the tax rate is 1% for the underused housing tax if you are an affected owner and you don't have an exemption. So when you add up the City of Vancouver empty homes tax, and you add on the BC speculation and vacancy tax, and then you tag on another one for the federal underused housing tax, you've got a total of 6% if you are unfortunate enough to have a Vancouver property and be subject to all 3 layers of tax. It's a 6% tax for having a property underutilized, okay? There are significant penalties for failing to file. So if you are an individual owner and you fail to file, that's a $5,000 penalty. If you are a corporation and you fail to file, that is a $10,000 penalty. So that's a really significant filing penalties, okay? Okay, so let's talk about excluded owners. Excluded owners are individuals who are Canadian citizens or permanent residents. So if you are a Canadian citizen or a permanent resident, you are exempt. So you are an excluded owner. You do not have to file. But I do want to point out that sometimes you are a Canadian citizen or a permanent resident, but you are still required to file if you are owning that property through a trust or through a partnership, for example, okay? Other entities here are listed for who are excluded owners. I'll leave that up there for, well, it'll be in the slide deck so everybody can take a look at it afterwards. Now, affected owners are those who are any entity that is not an excluded owner. So automatically, if you are not a Canadian citizen or a permanent resident, you fall into affected owners. If you are a foreign corporation, you are an affected owner. If you are a Canadian corporation, but a privately held Canadian corporation, think about all of your holding companies. So if you're a PREC and you have a holding company and you own residential property through that holding company, you are an affected owner. You need to file, okay? And I got some more examples here of affected owners because there's so much confusion around this. So even if you are a Canadian citizen or a permanent resident and you normally think you would be part of the excluded owners, however, you are an owner because you are a trustee. So if you're a trustee, then you actually are part of the affected owners. So you have to file a return just so that you can declare that you are a trustee of a trust, and therefore you have to file, okay? Another example of, well, I'll give you another example here, a very common one. So let's say, for example, you got, mom and dad, or mom or dad, who are on title to a property for their children, and the only reason why they're on title is to help with the mortgage qualifying, but they don't actually have an ownership interest in the property itself. So therefore, you have a situation where on the legal title, you've got mom, dad, and one of the children that are listed as property owners. But in reality, mom and dad have no ownership interest in the property at all. So in a situation like that, mom and dad are actually holding their ownership interest in trust for their children. They don't have any beneficial interest at all. So mom and dad actually needs to file as trustees of a trust. So now you have a filing requirement because you are an affected owner. The mom and dad are affected owners. Same situation could happen when you've got brothers and sisters who are, co-signing each other's mortgages, for example. That's also an example of a trust relationship. And then here, when it comes to a different type of affected owner, you could be a Canadian citizen or a permanent resident, but if you own property as part of a partnership, you are part of the affected owners group. So the Canada Revenue Agency defines a partnership as a relationship between two or more people who are carrying on a business, rental business included, in common with a view to profit. So think about all of those rental properties where you have joint owners. It could be spousal relationship too, husband and wife owning a property together with the view to profit because they're earning rental income. That's a partnership, right? So where you have a partnership, you are required to file because you are an affected owner. So if you are an affected owner, you have to file the UHT return. And in a lot of cases, you're only filing the UHT return for the sake of claiming an exemption. You're not actually taxable. You just have to file, right? And that's where the situation is really grave for a lot of people, because a lot of times people don't even know that they are part of the affected owners group and are required to file. So if you have clients that are in either of those examples that I gave you earlier, you got to make sure that they know that they have a potential filing obligation, okay? Now, in terms of the UHT exemptions, there's a whole list of exemptions. I've given the website address here for the exemption, but some common ones would be, for example, new construction, or if the property is a vacation property in a designated area, then the owner occupies it for at least 28 days out of the calendar year. That will get you an exemption under the vacation property rules. If the property is owner occupied as well, that will get you an exemption. Or if the property is tenant occupied for at least 180 days or more of the year. So very similar to the BC speculation tax, if the property is occupied by a tenant 6 months out of the year, you're also good with the with an exemption. Okay, so there's lots of exemptions available out there, ladies and gentlemen. Make sure that you take a look at that link and get your clients in front of an accountant so that they have an opportunity to determine for themselves whether they are required to file. So that being said, do we have any questions at all? I've got my phone number and email address on there for you. I'm also going to send you the slide deck. So Michael, I'll send you the slide deck. You can then distribute to the team. With that being said, I want to thank everybody for this morning, for your time. Michael, thank you very much for inviting me here. I really appreciate the opportunity to speak to your agents. I'm always available to everybody. So if you guys have any questions about this or anything else related to real estate taxes, I am your real estate tax specialist. So please don't hesitate to leverage me and utilize me to, keep yourself out of trouble and keep your clients out of trouble as well too. So with that being said, Michael, I'm going to turn the microphone back to you. Thank you very much for your time, everybody.